Is crypto chart analysis reliable, or would you be better just looking at the stars? In the volatile world of cryptocurrency, many investors and traders turn to technical analysis, TA, to make sense of the chaos. Candle patterns, Fibonacci retracements, RSI levels, and moving averages have become a language unto themselves for the chart savvy. But the question remains, how reliable is crypto chart analysis really? And is it worth putting your trust in these digital tea leaves, or would something like astrology be just as practical? What is crypto chart analysis? Crypto chart analysis, also known as technical analysis, is the practice of predicting price movements based on historical data with a primary focus on price and volume. It doesn't care why a price moved, it simply looks at how it moved and uses that information to predict future behavior. Tools include support and resistance levels, trend lines, indicators like MACD, RSI, and Bollinger Bands, chart patterns like head and shoulders, flags, or triangles. The case for chart analysis. Human behavior is predictable. Sometimes markets are driven by emotion, fear, greed, hope. Since humans often react in patterns, especially in mass psychology, TA attempts to catch these moments of decision-making and capitalize on them. Self-fulfilling prophecy. Many traders use the same indicators. If enough people act on the same signal, say a breakout above resistance, that very action can move the market, making the prediction come true. Short-term edge TA often provides valuable insights for short-term trades, particularly in high-volume markets. Even in crypto's famously erratic ecosystem, certain levels and patterns can influence the odds of success. The case against it. Crypto is wildly volatile. Unlike traditional markets, crypto is still relatively immature. It's often driven more by headlines, whale movements, or regulatory news than by any chart pattern. Low liquidity, false signals. Many altcoins or thinly traded tokens produce unreliable charts. A single large buy or sell order can fake a breakout or breakdown, leaving technical traders holding the bag. TA ignores fundamentals. Crypto is deeply influenced by fundamentals, including protocol upgrades, partnerships, and court rulings, such as Ripple's long-running case against the Securities and Exchange Commission and sudden network failures. TA doesn't see any of that coming. Analysis, paralysis. Two traders can examine the same chart and reach opposite conclusions. That ambiguity can make it more art than science. What about astrology? You may be surprised to learn that financial astrology is a genuine niche. Some traders align their decisions with lunar cycles or planetary alignments. While this might sound outlandish, it's no more irrational than blindly following a chart pattern without context. Astrology reminds us of an important truth. People crave patterns, even where none exist. So, is it worth believing? Here's the balanced view. Crypto chart analysis can be constructive for short-term trading as it aids in timing entries and exits. It should not be your only tool. Combine it with an understanding of market sentiment, news, fundamentals, and macro trends. For long-term investing, fundamentals almost consistently outperform technicals. And if you find comfort in gazing at stars, that's fine too. Just don't bet your life savings on Venus entering retrograde. Final thoughts. Crypto chart analysis is not a crystal ball. It's more like a weather forecast. It can give you probabilities, not certainties. If you use it wisely, with risk management and awareness of its limits, it can give you an edge. But if you're expecting it to tell you exactly when to buy and sell to become a millionaire overnight, you might be better off consulting a horoscope. So, whether you're squinting at candlesticks or stargazing, always remember in crypto, skepticism is your best friend, and risk management is your life jacket.